Hi candidates, welcome to another session of Manifested Online Classes. We are still continuing the topic of group accounts, and in our most recent session we discussed on how to prepare the group account or the consolidated statement of cash flows. So in this particular session I want us to illustrate the same. We illustrate how to prepare the group cash flow by looking on a question which is here. So we go through it and then we see what is required. So the question reads, the following draft consolidated financial statements were extracted from the financial record of G Group for the year which ended 30th of September 2022. So we are given the consolidated statement of profit or loss for the year which ended 30th September 2022, where we have the revenue, cost of sales, gross profit, distribution cost, administrative expenses, profit from operation, and then we have the fair value gain on short-term investment, finance cost, and then we have the profit before tax, income tax expense, and then we have the profit for the year, which has been split into a profit attributable to the owners of the group and the profit attributable to non-controlling interest. Then we also given the consolidated statement of financial position as at 30th of September 2022 and 2021, where we have the non-current asset, including property, plant and equipment, goodwill, and then at the current asset we have inventory, trade receivables, investment at fair value through profit or loss, and then we have cash at bank. At the equity we have ordinary share capital, we have share premium, retained earnings, and then we have equity attributable to group owners. We have non-controlling interest. Then at the non-current liabilities we have deferred consideration, a bank loan, and then we have the deferred tax. And at the current liabilities we have the trade payables and then the current tax. Then from there we have some additional information, number 1 up to note number 5. We are going to go through those particular workings as we basically we're going to go through the additional information as we do some few workings, and then what we are required to do here is to prepare a consolidated statement of cash flows for G Group for the year which ended 30th of September 2022 using the indirect method in line with the International Accounting Standard number 7. So what we need to do here, let's go through the additional information and we do some few workings based on that additional information. So in the additional information, number 1, we are told that property, plant and equipment comprised of the following. So here we are given the property, plant and equipment as at 30th of September 2021 and 30th September 2022. So it is very important for you to note that anytime you come across a question for group cash flow, you'll be given the information for the previous year and the current year. Like in our case, the current year ended 30th of September 2022, and then the previous year ended on 30th of September 2021. So the balances which are given here as at the end of the current financial year, these are the closing balances, whereas these are the closing balances in the previous year, but during the current financial year, these are the opening balances. These are the opening what? Balances. So therefore, we have the opening balances and the closing balances. And in note number 1, you're given information about the PP, whereby you're given the cost, and also we are given provision for depreciation, and then we're given now the carrying amount. So that is the information which are given, and then we are told during the year in sentence 2 of note 1, during the year which ended 30th of September 2022, which is the current year, G Limited disposed of an item of equipment at cash proceeds of 260 million. The equipment had a cost of 750 million and accumulated depreciation of 370. So anytime one of the company within the group sell an asset, so what we need to do is basically to determine the gain or the loss on disposal. So we determine the gain or loss on disposal by preparing something called the disposal account. The disposal account, So this particular account, number one, we debited with the cost of the asset which was disposed. And then on the credit side, we have two items, the accumulated depreciation and the sales proceeds. The sales proceeds. So that item number one, you're told had it was sold for 260, the sales proceeds, 260 million. And then we are told it had a cost of 750 million, and then it had accumulated depreciation of 370. So what we do is to balance this account, and any balancing figure on this side is a loss on disposal, whereas a balancing figure on this side is a gain on what? A gain on disposal. So let's see what we have. On the credit side, we have 370 plus 260, which is 630, less than what we have here. So mean that the balancing figure will be on this side, which now is a loss on disposal. So this particular loss on disposal is always taken into account as an expense in preparing, or basically in computing the profit or loss for the year. But it is important to note that this particular loss on disposal, this is basically a non-cash item, is one of the non-cash item, and therefore what you're going to do in computing the cash flow from operating activities, this amount, because it was taken into account as an expense in arriving at the profit for the year, we are going to add it back because it's a non-cash item. So, and then from there, actually, in the last sentence of note 1, you're told any gain or loss on disposal, like what we have here, and also depreciation on property, plant and equipment is included in the cost of sales. So therefore this one is already included in the cost of sales, meaning that in arriving at the profit for the year, it has been deducted, and therefore because it's a non-cash item, what you're going to do, we are going to add it back. We are going to come back as far as note 1 is concerned, or even before you go to note number 2, there are two accounts we need to prepare as or using the information which we have in note number 1. The first account is the PP account, which we prepared cost, and the other account is the provision for depreciation, because in most of these particular questions for cash flow, there is something which the examiner will not have given you. One, the PP which were purchased, and also the depreciation for the current year. You can only be able to compute those two items, PP acquired, depreciation for the current year, by preparing two accounts. So therefore, the first account we need to prepare here is the PP account. PP account. So in this particular account, we are going to prepare it at cost. So take into account this is an asset account. The opening balance should be on the debit side, and the cost of the PP at the start of the year was 30,000. The cost of the PP at the end of the year was 43,000. Then also, as per the information given in note number 1, okay, before we record that, let's open that the other account, which is called provision for depreciation account. Provision for depreciation account. So the provision for depreciation account, these accounts always has a credit opening balance. So the opening balance is 15,250, and then the closing balance is balance carried down is 19,500. 19,500. Then also, as per the information given in note 1 regarding this item of PP which was disposed, anytime an item of PP has been disposed, we credit it in this account because it reduces the value of PP at the start, and we credit it in this account at cost, which is 750. And then the accumulated depreciation for this item which was disposed, we debit it in this account. Accumulated depreciation, which is 370. Yes, that is the accumulated depreciation on the item of PP which was disposed. Let's just refer to this as a accumulated depreciation, or basically this is related to item of PP which was disposed. Or the other entry here will be in the disposal account. Yes, that's what we have. Yes, let's go to the addition information number 2, and you're told on 1st of January 2022, D Limited G Limited basically is a parent company. That's why you can see here we are talking of a G Group. G is the parent company. Acquired 75% of the 100 million ordinary shares of shillings 10 each in S Limited. The acquisition consideration comprised of a share exchange on the basis of 2 shares in G Limited for every 3 shares acquired in S Limited. And then you're told G Limited was also to pay 810 million to the owners of S Limited on 1st of January 2023. And basically these are deferred consideration. These are consideration to be paid sometime in the future. So therefore it's a deferred consideration. And if you can remember what we discussed in our what we have already discussed in our previous sessions, anytime the parent company is to pay some consideration in the future, which is a deferred consideration, we have to discount it to its present value using the parent company cost of capital, and then we do what? We amortize it. This is something we have already discussed in our previous sessions. So, and that's why you can see in that case we are told G Limited cost of capital is 8% per annum. So that is for discounting, but I think we will come back to that when computing the goodwill. So I think first of all we can skip that information, though there are some workings which are required there. And then we also told the market value of the ordinary shares as at 1st January 2022 were 30 shillings and 20 shillings for G Limited and S Limited respectively. And then you're told the fair value of the assets and liabilities of G Limited at the date of acquisition were as follows. So we are told the parent company here acquired a subsidiary during the current financial year, and the subsidiary acquired is S. So in paragraph 2 of note 2, we are given the asset and liabilities of that subsidiary which was acquired. So what we take into account here, specifically in this account, are the PP of that subsidiary which has been acquired. So the PP of the subsidiary acquired, and we add them to the PP of the group at the start at cost. So equally those PP, they had accumulated depreciation of 29. So that accumulated depreciation for subsidiary acquired, we credit it in this account because that is supposed to increase the accumulated depreciation of the group at the start. We credit it there. Yes. So I think that's what we have. And then we're given other items of asset liabilities. So we're going to use those items in doing other workings. Then the net asset are given as 2,500. We are going to use that still in the computation of goodwill. And then you're told in note number 3, the group policy is to measure and controlling interest in subsidiaries at fair value at acquisition date. So automatically, if you come across that particular information, you need to note that when computing the goodwill, then you have to use the full goodwill method, because you are told is a policy of the group to measure NCI at fair value on the date of acquisition. And then you're told the market value of subsidiary shares are considered to be the representative of the fair value of the shares held by NCI. I'll show you how to use that information specifically in computing the goodwill. And then number 4, we are told investment at fair value through profit and loss consists of highly marketable and risk-free securities held by G Limited. So in other terms, what that means is that the investment at fair value through profit and loss, and which is part of the current asset, this is part of the cash equivalent. That is part of the cash what? Equivalent. And then number 5, we are told any impairment loss on goodwill is included as part of the administrative expenses. So I think maybe we need to balance this particular 2 accounts here, and then from there maybe you can compute the goodwill on acquisition. So I don't think we have anything which will affect this account, because maybe the other item we can check is whether there was any revaluation gain, whether there was any item of PP which was revalued upward, or whether there was a revaluation loss which should be credited in this account. I think in our case we don't have anything else, so what we just need to do is to balance this account, and mostly the balancing figure which will be on this side represent the PP which were acquired, which the examiner will not have given you. So what we do, we add the amount we have on the credit side. We have 43,000 43,000 plus 750 minus what we have on the debit, which is 35,000. And that will give us 8750. 8750. So this is what? These are acquisitions. These are PP which were acquired. Remember, you're going to take into account this in preparing our cash flow, specifically when computing the cash flow from investing activities. This is one of the items you're going to consider. Then we also balance this account, and the balancing figure in this account here will be on this side, and basically these represent the depreciation for the current financial year, and which was deducted or which was taken into account in the computation of the profit or loss for the year. So on the debit side, we have 370 plus 19,500 minus what we have on the credit side, minus what we have on the credit side. That is a figure of 15 to 50 minus 29 and then 29. So that will give us 1720. That is the depreciation for the current financial year, and which also we are going to take into account in computing the cash flow from operating activity. So I think that is it as far as PP is concerned. Maybe you can go back to note number 2. There is something we need to compute there. Note number 2, as far as the acquisition of that subsidiary is concerned. First of all, we can compute, let's compute the goodwill on acquisition. The goodwill on acquisition of S Limited. Goodwill on acquisition of S Limited. So here we need to have 2 columns, and our figures are in million of shillings. So always here we start with the cost of investment. So the cost of investment is basically the purchase consideration paid by the parent company in acquiring shares of S. So we are told in note 2, sentence number 2, we are told the acquisition consideration consisted of share exchange. So we have share exchange consideration, exchange consideration, and basically that share exchange consideration we are told was to be, or the share exchange consideration comprised of a share exchange on the basis of 2 shares. The basis of 2 shares in G Limited. So the parent company was to issue 2 shares for every 3 shares which were acquired. 3 shares which were acquired. So in this case, what we need to do, we need to determine how many shares were acquired by the parent company, that is G Limited, in S Limited, because we are told G Limited acquired 75% of 100 million shares of S. So the shares which were acquired automatically will be 75% of this, which will give us 75 million. These are the shares which were acquired. So what we need to do is to determine the shares issued to pay the purchase consideration. So we take 2 times 75 million divided by 3. Divided that with 3. So this will give us what? This will give us, we have 75 divided by 3 times 2. So this will give us 50 million shares. And then what we do is that we take the shares now which were issued by the parent company, 50 million, we multiply them with their fair value. So what was the market value or the fair value of G Limited shares on the date of acquisition? That is given in paragraph 2 of note 2, where we are told the market value of ordinary shares at 1st January 2022 was shillings 30 and shillings 20 for G and S. G and S. So the shares of G, because the parent company is the one which issued these shares, the shares of G had a market price of 30. Market price of 30. So we multiply the 2, which will give us 1,500 million. So this is the share exchange consideration. Also, we are told that the parent company, that is G Limited, also promised to pay another consideration in the future. That is now the deferred consideration. The deferred consideration. So the deferred consideration in this case, we are told, is 10 million. And because it will be paid on a future date, remember the acquisition took place on 1st of January 2022. 1st January 2022, we are told that this 10 million will be paid on 1st of January 2023. 1st January 2023, that is after 1 year. So therefore, what we need to do, we need to discount this to its present value. So how do we discount this to its present value? We multiply that with a present value interest factor, which is equal to 1 plus R raised to power negative n. So our R in our case here is the parent company cost of capital, which is 8% raised to power negative 1. Raised to power negative 1. So we have 1.08 raised to power negative 1 times 810. So this will give us 8. Okay, so let me. So we have 0.9259. 0.9259 times 810, which will give us 750. This is a 750. This is a 750. 750. So that is the present value of the deferred consideration. Present value of the deferred what? Consideration. So therefore, the cost of investment here comprised of the share exchange consideration and the deferred consideration. And because you're using the full goodwill method, to this then we need to add the NCI at fair value. NCI at fair value is also not given. So how do we compute this? Very simple. We determine the shares held by the minority shareholders in that subsidiary, which will be 25% of 100 million of 25% of the shares issued by S times their fair value. So the fair value of these particular shares, as per note number 2, paragraph 2, is 20 shillings. So therefore, that's how we compute the NCI at fair value, because it's not given. So we have 25 times 100 times 20 times 20, which will give us 500. So what we do, we add off that plus 750 plus 1500 plus 1500, which will give us 2750. 2750. Yes, and then to this what we do is that we less fair value of net assets acquired, fair value of net asset acquired, which is given in note number 2 as 2500. So therefore the goodwill on acquisition here is the difference, which is 250. So that is a goodwill on acquisition. So why do we need to have or to compute this particular goodwill? And basically, take into account, we don't use this goodwill in preparing our statement of cash flow. This goodwill is required for us to be able to determine any impairment loss. Remember, in note number 5, we are told any impairment loss on goodwill is included as part of the administrative expenses. So therefore, how do we compute the impairment loss? Impairment loss. So to compute the impairment loss, we can use this particular approach. We take the goodwill at the start of the year. We take the goodwill at the start of the year, that is balance brought down. The value for goodwill, we get that in the statement of financial position, consolidated statement of financial position at the non-current liabilities. So the goodwill at the start was 4140. 4140. So to this we add goodwill of a subsidiary acquired. Goodwill of the subsidiary acquired is 250. This will give us 4390. So actually this should be the same with the goodwill at the end of the year. Goodwill at the end of the year. But the value of the goodwill at the end of the year is 42. is 42. So you can see the value of goodwill has reduced with an amount of what? 190. So this reduction in the value of goodwill, this one is an impairment loss. And in our case, what you are told in note number 5 is that this particular impairment loss here is included as part of the administrative expense, and we also know that this goodwill is a non-cash. Sorry, this impairment loss is a non-cash item. And because it has already been deducted in arriving at the profit for the year, what we are going to do, we are going to add it back. That's why it was important for us to determine that particular impairment, that particular goodwill. I think with that particular information, first of all, we can proceed and prepare our statement of cash flow.